The digital banking revolution. How financial technology companies are rapidly transforming the traditional banking industry through disruptive innovation. Written by Luigi Wewege, narrated by Jim Cassidy. The Digital Banking Revolution. Forward by Thomas J. O'Rourke, former large bank examiner in charge and team lead for Northeast Region, the Office of the Comptroller of the Currency, United States Department of the Treasury, December 2016. For many years, retail banks have been secure, highly profitable businesses. However, recent industry disruption has come knocking at the door of these financial giants. The turning point was the global financial crisis experienced between the years 2007 and 2009, which not only led to large losses and even the collapse of a significant number of established banks, but has shaken the trust of financial customers worldwide to their core. These factors, combined with the fact that banking has been relatively undisturbed for centuries, meant it was time for change, and that change has been the rapid rise of financial technology companies. Emergent, innovative financial technologies are profoundly changing the way in which we spend, move and manage our money, unlike ever before. The digital transformation and its pace of change have been truly astounding, dramatically shifting customer behaviours and expectations of their financial service provider. Retail banks must now become positioned to fulfil their customers' every financial need, especially as the millennial generation is poised to soon command the largest purchasing power of any age group, and banks will need to become cognizant of this generation for a multitude of reasons. Research undertaken by the Cassandra Report into how millennials conduct their financial services has shown a defined trend in that they typically do not have the same legacy relationship with their banks as older generations have had. The research indicated that millennials judge banks based on their digital capabilities and will not hesitate to switch their bank account to another provider if they consider a better banking service available. The overall progress of financial service innovations has been driven by adoption across all age groups. But the demand from the millennial generation to push the boundaries of innovation and think about financial services differently has been a major catalyst for disruptive change. I consider The Digital Banking Revolution a well-written and an informative listen, capturing the current dramatic shift of how financial innovative technologies are shaping the future of banking services. The audiobook also provides those who work at senior management level within the banking and finance industry with an invaluable resource outlining how to adapt, evolve and succeed in this digital age. Additionally, I would recommend this audiobook as a must-listen for those who wish to gain a deeper understanding of how financial services will be conducted going forward. Introduction. Banks have always fought to gain absolute power and market share, knowing their competition and serving a marketplace that had relatively few alternative choices. However, the battlefield is changing as financial technology advances and new players emerge. Today, financial customers have become restless, demanding more from their financial service providers than ever before. Many retail banks around the world have now reached a pivotal moment in their history, and they need to transform through financial technological advancements to stay relevant, or risk the possibility that agile financial startups could confine them to a limited utility role. This challenge comes at an inopportune moment for retail banks, just as industry profitability stagnates and customer loyalty becomes even more tenuous. To illustrate how rapidly new technology can transform an industry, consider that it took just 18 months for Google to erase 85% of the market capitalization of the biggest GPS companies in the world after the launch of its Google Maps app. Alibaba, on the other hand, which is considered China's equivalent to Amazon, became the world's fourth largest money market fund only 9 months after entering the market. These examples show how today's technology-enabled disruptors can dramatically change markets in a short period. For many, the first real disruptor to enter the banking sector in the current era was PayPal. Initially, traditional banks treated PayPal as an annoyance, limited to eBay and with little potential to disrupt the highly lucrative and bank-dominated payments industry. How wrong they were. And at the end of 2015, it was reported that PayPal had 173 million customers, $9.2 billion in revenue and $1.2 billion in profit, and was more valuable than their parent eBay. PayPal has paved the way for the payments space to be transformed, with popular retailers having also shown remarkable success moving into payments. And for example, the Starbucks loyalty card handles nearly 1/3 of the company's United States-based transactions. Previously, a tight regulatory environment has always acted as a barrier to entry for those who wanted to access the banking industry. But today, these barriers are constantly becoming more relaxed. To illustrate, PayPal has been a licensed bank in Europe since 2007, and Facebook, which has more than 250 million users in Europe, may soon be authorised by the Central Bank of Ireland to handle payments across the entire European Union. Other new entrants who have grown rapidly without becoming regulated banks are Google with their wallet, TransferWise and SimplePay. Many of these non-bank financial institutions have all relied on similar white-label services such as those offered by the Bank Corp Inc., who are able to provide regulated banking services to their clients' customers. In a digital world, winning and retaining customers hinges on creating value for them that enhances the convenience and quality of their everyday lives beyond mere financial transactions. With more interaction comes more opportunity for selling. This point of view is at the heart of the success of major digital players such as Apple, Amazon, Alibaba and Google. For retail banks, this requires a dramatic shift in strategic focus, from being a provider of financial products and services to rather being a provider of solutions. Banks can't respond to these threats by simply being more technologically advanced or by reducing the number of branches they operate, but by rolling out better mobile and online banking services. What banks need to do is first defend their position, but also to learn how to play a greater role, not just at the exact moment of the financial transaction, but before and after it as well. For retail banks to ultimately regain control in this era of digitization, as well as succeed in an increasingly competitive market, they'll need to outsmart and outmaneuver these new financial disruptors. Although this will not be an easy undertaking. Overview. The past provides lessons. Before setting forth the reasons informing my view that traditional retail banks are facing extinction, I consider it important to understand the historical underpinnings which influenced the evolution of the banking system and which impart insight into its current structure and organisation. I firmly endorse the proposition that the past provides lessons for the present and guidance for the future. Although one is unable to predict the future, one can, with a perspicacious eye, discern the complex interaction of historical forces and factors that produced the conditions which enabled a select few people to identify niches for their companies and set the finance industry on a new, unimagined trajectory. A brief history of banking. The earliest known practices of banking, as attested by written standards, originated in Babylonia around the 2nd millennium BC. These standards were part of formal laws enshrined in the Code of Hammurabi. Apparently, these ancient banking transactions were quite like the practices of modern-day banking. For example, deposits were not of capital but of grain or other crops, cattle and precious metals. This demonstrates that the fundamental concepts underlining modern-day banking systems were already evident in these primitive arrangements. Loans were advanced, deposits were received, and borrowers paid interest. Similar such rudimentary banking arrangements were also prevalent in ancient Egypt, having originated in the need for grain yields to be stocked in warehouses of the centralised state. How this would work is that depositors used written orders for taking out specific quantities of deposited grains. This system proved so effective that it became self-sustaining, spawning parallel banking practices with respect to precious metals and coinage. However, it is not just the Egyptians who can claim credit for modern-day banking practices. This is due to the well-documented history of banking in Italy, tracing back to the medieval cities of Venice, Florence and Genoa. The bankers of Italy at that time advanced credit to princes to sponsor their lavish lifestyles, as well as fund wars and to assist merchants engaged in international trade. In fact, trading families at the time established most of these early banks in Italy as a division of their more wide-ranging business practices. The Peruzzi and Bardi families were, by the 14th century, known as the wealthiest bankers in Florence. They, as part of an imaginative vision to expand their operations, established bank branches in various regions across Western Europe. Both family banks extended substantial loans to the King of England, Edward III, to sponsor his 100-year battle against France. But the king ultimately fell into arrears of payments and defaulted, which contributed to the early demise of these banking giants. It must be noted that a discussion on banking in the medieval era would be incomplete without mention of Medici Bank, which is considered the most well-known of the Italian banks in this period. It was established in the year 1397 by Giovanni Medici, who was motivated by the success that the Medici family had garnered as money exchangers. Giovanni was an astute businessman and early on decided to shift the business from its green-covered counter in the Florence market to a nearby palace. This move resulted in a substantial increase in wealthy clientele. Giovanni, similarly to the Peruzzi and Bardi families, realised that to increase his banking business, he needed to expand beyond the Italian territorial boundaries. He then swiftly set about establishing many bank branches throughout Europe, although his primary focus was on one country, which was England. Due to his entrepreneurial drive, the bank quickly grew, deriving its prestige both from its association with royals and merchants and from its status as the main bank of the Pope. Over time, it was the patronage by the Vatican, as compared with business derived from other clients, that resulted in gains for the bank, and it was this success that enabled it to expand and establish a substantial amount of bank branches. Later, during the 17th and 18th centuries, the British and Dutch began to pattern their banking practices on the Italian medieval banking model. In their subsequent adaptation of the system, they incorporated new features and enhancements, one of which is attributable to the goldsmiths of London around this period. This was the acceptance of fractional reserve banking. By the middle of the 17th century, the English Civil War had culminated in the termination of the goldsmith's conventional trade of making objects from silver and gold. The hapless goldsmith was thus compelled to create another way in which to survive, and he did this by devising means for safely storing valuable metals. Goldsmiths then began to start accepting precious metal deposits for security purposes, and in exchange they would issue receipts. Initially, these receipts circulated as an alternative currency. However, the goldsmiths soon became aware that the depositors were not all at the same time demanding the return of their silver and gold. The goldsmiths quickly realised that they could create extra revenue streams by increasing the number of receipts issued as compared with the value of the metal. Accordingly, the goldsmiths promptly abandoned their prevailing mode of operation and switched to a new pattern of trading, which was to become known as fractional banking in its earliest form. Soon after, contemporaneously with the foundation of the Federal Republic of the United States in the 18th century, this banking method was introduced to the New World, leading to the integration of national and state banks into the mainstream of the United States economy. Just 5 years after the Declaration of Independence, the first chartered bank became operational in Philadelphia in 1781, and by the year 1794, 17 further bank branches had been established throughout the country. At the time, bank charters could be granted only by statute. However, by 1838, the state of New York had introduced legislation providing for the deregulation of banking and permitting any person to set up a bank subject to the fulfillment of specific requirements. As free banking spread rapidly to other states, serious flaws soon became apparent in the system. For example, banks functioning under state laws enjoyed the right to issue their own banknotes, thus leading to the problem of currency multiplicity. Such practice of unilaterally issuing notes was abolished following the introduction of Civil War legislation in the form of the National Banking Act of 1863, which both inaugurated a completely new system of national banks and created a uniform national currency. Additionally, this legislation continued the empowerment of state-owned banks to issue notes, but at the same time authorised the government to impose a 10% tax on state bank bills, forcing most state banks to convert to national banks. A radical innovation in banking regulation that emerged around this time was the requirement that national banks secure their notes with Treasury securities, thereby creating something equivalent to what we know now as a bank deposit guarantee scheme. What was so revolutionary about this regulatory reform was that in the event of default by the bank, it would provide a safety net for the possessor of currency notes. The passage of this legislation was a milestone in banking regulation, as not only did it make all banks liable to comply with a single set of laws and policies, but it also established an agency named Office of the Comptroller of the Currency, which became the precursor to the Federal Reserve System and subsequent supervisory authority over all banks. Banking in the modern era. The first decade of the 20th century saw immense banking panic in the United States. In 1907, there were numerous runs on the banks, which became known as the bankers' panic. Later, during the financial crash of 1929, preceding the Great Depression, margin requirements were set at only 10%. In other words, brokerage firms could lend $9 for every $1 an investor had deposited with them. When the market collapsed, brokers then called in these loans, which could obviously not be paid back. Banks then began to fall as debtors defaulted on debt and depositors attempted to withdraw their deposits en masse, triggering numerous bank runs. At the time, government guarantees and Federal Reserve banking regulations to prevent such panics were ineffective. Bank failures led to the loss of billions of dollars of assets, and outstanding debts during this period became even larger due to prices and incomes falling by an estimated 20 to 50%. After the panic of 1929 and during the first 10 months of 1930, a record number of United States banks failed, an incredible total of 744. By April 1933, around $7 billion in deposits had been frozen in failed banks or those left unlicensed after the March bank holiday. Bank failures continued to snowball as desperate bankers called in loans that borrowers did not have the money or ability to repay. With future profits looking poor, capital investment and construction slowed, or in some cases completely ceased. In the face of bad loans and worsening prospects, the surviving banks became even more conservative in their lending. Banks then built up their capital reserves amid fewer loans, which intensified deflationary pressure, and a vicious cycle developed, accelerating this process. Once the proverbial dust had settled, in all, over 9,000 banks failed during the 1930s. In response, many other countries, having seen what had just happened to the United States financial system, decided to significantly increase their financial regulation. The American government at the time also decided to follow suit by establishing the Securities and Exchange Commission in 1933, and later passed the Glass-Steagall Act, which separated investment banking and commercial banking. Ultimately, the main motivation behind this was to avoid more risky investment banking activities from ever again causing commercial bank failures. During the post-World War II period, and with the introduction of the Bretton Woods system in 1944, two organisations were created, the International Monetary Fund and the World Bank. Encouraged by these institutions, commercial banks decided to start lending to sovereign states in the Third World. This was around the same time as inflation started to rise in the West. The abandonment of the gold standard in 1971 came as a surprise to a number of banks whose balance sheets nosedived, and many other banks went bankrupt simply due to third world country debt defaults. This period was also a time of a never-increasing use of technology in retail banking. In 1959, banks agreed on a standard for machine-readable characters, MICR, that was patented in the United States for use with checks and which subsequently led to the first automated reader sorter machines. In the 1960s, the first automated teller machine, ATMs or cash machines, were developed, and these machines became a lot more prevalent by the end of this decade. Banks during this period realized the potential use of technology, and many of them decided to become heavy investors in computer technology. The bank's intention through this investment was to be able to automate much of the manual processing, which ultimately led to the decline of the high number of clerical staff members that banks had to hire up until that point. By the 1970s, the first payment systems started to evolve, which would eventually lead to electronic systems for both international and domestic payments. The International SWIFT payment network was established in 1973, and not long after that, alternative payment processing systems started to be developed by international banks, who were being encouraged to do so by their respective governments. A decade on, and global banking plus capital market services proliferated during the 1980s after the deregulation of financial markets in many countries. The 1986 Big Bang in London allowed banks to access capital markets in new ways, which soon led to significant changes in the way banks operated and accessed capital, as well as a new trend of retail banks beginning to acquire investment banks. Much like the 1980s, banking services continued to grow throughout the 1990s, largely due to a greater increase in demand from companies, governments and financial institutions, which led to market conditions during this period becoming buoyant and overall bullish. During this period, interest rates in the United States declined from about 15% for 2-year US Treasury notes to about 5% during the 20-year period, and financial assets grew at a rapid rate, which at the time equaled approximately twice the rate of the world economy. This era also saw a significant internationalization of financial markets, and the increase of US foreign investments from Japan not only provided the funds to corporations in the United States, but it also helped finance the federal government. The dominance of the United States financial markets had been disappearing, and because of this, there became an ever-increasing interest in foreign stocks. The extraordinary growth of foreign financial markets at the time resulted from large increases in the pool of savings in foreign countries such as Japan and the deregulation of foreign financial markets. This led to American corporations and banks starting to seek investment opportunities abroad, prompting the development in the United States of mutual funds specializing in trading of foreign stock markets. Such growing internationalization and opportunities in financial services completely changed the competitive landscape, as now many banks demonstrated a preference for the universal banking model prevalent in Europe. The reason why it was preferred was because universal banks were free to engage in all types of financial services, thus making it possible for a variety of investments and enabling them to become a one-stop shop supplier of both retail and wholesale financial services. The early 2000s were largely marked by the consolidation of existing banks and the entrance into the market of other financial intermediaries, non-bank financial institutions. Large Fortune 500 companies at the time began to realize the vast potential returns they could generate through banking. Thus, many of them decided to find their way into the financial service community, offering unprecedented competition to established banks. Many of these non-bank financial institutions offered services that included insurance, pensions, mutual funds, money market accounts, loans and credits plus securities. By the end of 2001, the market capitalization of the world's 15 largest financial services providers included 4 non-banks. This development became a catalyst for financial innovation, which advanced significantly in the first decade of the 21st century, and consequently further increasing the importance and profitability of non-bank finance. Most established retail banks during this period witnessed a massive decline in their profitability due to the emergence of the non-banking industry. This prompted the Office of the Comptroller of the Currency, an independent bureau within the United States Department of the Treasury, to encourage banks to explore other financial instruments to diversify their business, as well as improve their liquidity. However, as these financial instruments started to become increasingly more reviewed and then subsequently adopted by both the banking and non-banking industries, the distinction between these two different types of financial institutions gradually started to vanish. The combination of financial innovations in banking over the past decade has triggered a major shift away from the traditional banking model to a new digital banking one. Non-banks during this period did have assistance with this change from a major catalyst, which was the evolution of personal computers. This technological advancement ultimately led to the right environment being created for financial transformation to gain rapid momentum in such a short period. Select major international events in banking history. 1100. Knights Templar run earliest known European-wide Middle East banking until the 14th century. 1397. The Medici Bank of Florence is established in Italy and operates until 1494. In 1542, the Great Debasement, the English Crown's policy, initiated coinage debasement during the reigns of Henry VIII and Edward VI. 1553. The first joint stock company, the Company of Merchant Adventurers to New Lands, was chartered in London. 1602. The Amsterdam Stock Exchange was established by the Dutch East India Company to deal in its printed stocks and bonds. In 1609, the Amsterdamsche Wisselbank, the Amsterdam Exchange Bank, was founded. 1656, the first European bank to use banknotes opened in Sweden for private clients. In 1668, the institution converted to a public bank. 1690s, the Massachusetts Bay Colony was the first of the 13 colonies to issue permanently circulating banknotes. 1694, the Bank of England was founded to supply money to the English king. In 1695, the Parliament of Scotland created the Bank of Scotland. 1716, John Law established the Banque Générale in France, a private bank. In 1717, Master of the Royal Mint Sir Isaac Newton established bimetallism with a new mint ratio between silver and gold that had the effect of driving silver out of circulation and thus putting Britain on the gold standard. 1720, the South Sea Bubble and John Law's Mississippi Scheme failure caused a European financial crisis and forced many bankers out of business. 1775, the first building society, Ketley's Building Society, was established in Birmingham, England. 1782, the Bank of North America was opened. 1791, the first Bank of the United States was chartered by the United States Congress for 20 years. 1800, the Rothschild family established European-wide banking. 1800, Napoleon Bonaparte established the Bank of France. 1811, the United States Senate tied on a vote to renew the charter of the first Bank of the United States. Vice President George Clinton at the time decided to break the tie and vote against renewal, and thus the bank was dissolved. 1816, the second Bank of the United States was chartered for 5 years, after the first Bank of the United States lost its charter. This charter was also for 20 years. The bank was created to finance the country in the aftermath of the War of 1812. 1817, the New York Stock Exchange Board was established. In 1818, the first savings bank of Paris was established. 1862, to finance the American Civil War, the federal government under United States President Abraham Lincoln issued legal tender paper money called greenbacks. 1874, the Specie Payment Resumption Act was passed. This provided for the redemption of United States paper currency in gold beginning in 1879. 1913, the Federal Reserve Act created the Federal Reserve System, the central banking system of the United States, and granted it the legal authority to issue legal tender. Between 1930 and 1933, in the wake of the Wall Street crash of 1929, more than 9,000 banks closed, resulting in a third of the money supply in the United States being totally wiped out. 1933, Executive Order 6102, signed by the United States President Franklin D. Roosevelt, forbade ownership of gold coin, gold bullion and gold certificates by U.S. citizens beyond a certain amount, effectively ending the convertibility of US dollars into gold. 1971, the Nixon shock, was a series of economic measures taken by United States President Richard Nixon which cancelled the direct convertibility of the US dollar to gold by foreign nations. This essentially ended the existing Bretton Woods system of international financial exchange. 1986, the Big Bang, which was the deregulation and reform of financial markets in the City of London, served as a catalyst to reaffirm London's position as a global centre of world banking. 2007. In the late 2000s, the financial crisis became a credit crunch, which led to the failure and bailout of many of the world's biggest banks. In 2008, Washington Mutual collapses, the largest bank failure in history up until that point. An imperfect system. Financial crises. The term financial crisis is applied broadly to a variety of situations in which some financial assets suddenly lose a large part of their nominal value. In the 19th and early 20th centuries, many financial crises were associated with banking panics, and many recessions coincided with these panics. Other situations that are often called financial crises include stock market crashes and the bursting of financial bubbles, as well as currency crises and sovereign defaults. Financial crises often directly result in a loss of paper wealth, but do not necessarily result in changes to the real economy. The financial crisis of 2007-2009. This crisis, largely known as the global financial crisis, is considered by many economists to have been the worst financial crisis since the Great Depression of the 1930s. It threatened the collapse of large banks and financial institutions that were considered too big to fail. For a period, many national governments were slow to act on bailing out their respective banks, which consequently led to major stock market drops around the world. One of the most affected areas was the United States, whose housing market suffered a great blow which resulted in evictions, foreclosures and prolonged unemployment. The financial crisis played a significant role in the failure of key businesses, major declines in financial customers' wealth, which was estimated to be in the trillions of US dollars, and a downturn in economic activity leading to a severe recession, as well as contributing to the European sovereign debt crisis. The active phase of the crisis, which manifested as a liquidity crisis, can be dated from August 9, 2007, when BNP Paribas terminated withdrawals from their 3 hedge funds, citing a complete evaporation of liquidity. Then, the bursting of the United States housing bubble, which peaked in 2004, caused the values of securities tied to US real estate to plummet in price, damaging financial institutions globally. The financial crisis did not come about due to just one event, but it was triggered by a complex interchange of policies that encouraged home ownership. There was easier access to loans for subprime borrowers. The overvaluation of bundled subprime mortgages based on the theory that housing prices would continue to escalate. Questionable trading practices on behalf of both buyers and sellers. Compensation structures that prioritise short-term deal flow over long-term value creation, and a lack of adequate capital holdings by banks and insurance companies to back the financial commitments they were making. Questions regarding banks' actual solvency, the decline in credit availability, and damaged investor confidence adversely affected global stock markets, with securities suffering large losses during 2008 and early 2009. Also, economies worldwide slowed during this period as credit tightened and international trade declined. During this period, international governments and central banks responded with unprecedented fiscal stimulus, monetary policy expansion and institutional bailouts. In the United States, Congress passed the American Recovery and Reinvestment Act of 2009 to help kickstart the American economy. Numerous causes for the financial crisis have been suggested by financial analysts and professors, and with varying weight, assigned by experts. Around this time, 2 reports were published and both are considered as potentially the most scathing release conclusions. First, the United States Senate's Levin-Coburn report, which concluded that the crisis was the result of high-risk, complex financial products, undisclosed conflicts of interest, the failure of regulators, the credit rating agencies and the market itself to rein in the excesses of Wall Street. The Financial Crisis Inquiry Commission concluded that the financial crisis was avoidable and was caused by widespread failures in financial regulation and supervision, dramatic failures of corporate governance and risk management at many systematically important financial institutions, a combination of excessive borrowing, risky investments and a lack of transparency by financial institutions, ill preparation and inconsistent action by government that added to the uncertainty and panic, a systematic breakdown in accountability and ethics, collapsing mortgage lending standards and the mortgage securitization pipeline, deregulation of over-the-counter derivatives, especially credit default swaps, and the failures of credit rating agencies to correctly price risk. A major policy event that also should be considered as contributing to the financial crisis was the 1999 repeal of the Glass-Steagall Act, which effectively removed the separation between investment banks and depository banks in the United States. Many critics continue to argue that credit rating agencies and investors failed to accurately price the risk involved with mortgage-related financial products, and that governments did not adjust their regulatory practices to address 21st century financial markets. Also, there was a lot of criticism that governments had not commissioned the undertaking of in-depth research into the causes of the various financial crises that had occurred before, which could have helped prevent the 2007-2009 crisis from happening. In the immediate aftermath of the financial crisis, palliative monetary and fiscal policies were adopted to lessen the shock to the economy, and the Dodd-Frank regulatory reforms were enacted in the United States to lessen the chance of recurrence. Additionally, the Basel III capital and liquidity standards became more widely adopted by most countries around the world, which helped stabilise markets. Financial innovation and complexity. Although much is known about the 2007 to 2009 financial crisis and its causes, what is surprisingly less known is how financial innovations and their complexity played a significant part in creating the largest global financial crisis that the world has ever experienced. The term financial innovation simply refers to the ongoing development of financial products designed to achieve particular client objectives. For example, offsetting a particular risk exposure, such as the default of a borrower or assisting with obtaining financing. Examples pertinent to this crisis include the adjustable rate mortgage, the bundling of subprime mortgages into mortgage-backed securities (MBS), or collateralized debt obligations (CDO), for sale to investors, which is a type of securitization, as well as a form of credit insurance called credit default swaps (CDS). The use of these products expanded dramatically in the years leading up to the crisis. All these products vary in complexity due to the ease in which they can be valued on the books of financial institutions. To illustrate the sheer growth of some of these financial innovations, CDO issuance grew from an estimated $20 billion in quarter 1 of 2004 to its peak of over $180 billion by quarter 1 in 2007, but then declined back under $20 billion by quarter 1 2008. Although it must be stated in conjunction that the credit quality of CDOs did decline from 2000 to 2007 as the level of subprime and other non-prime mortgage debt increased from 5% to 36% of CDO assets. Other financial innovations such as subprime lending, the CDS, and a portfolio of CDSs called a synthetic CDO enabled a theoretically infinite amount to be wagered on the finite value of housing loans outstanding, provided that the buyers and sellers of these derivatives could be found. For example, buying a CDS to insure a CDO ended up giving the sellers the same risk as if they owned the CDO, when those CDOs became worthless. The major boom of innovative financial products went hand in hand with the development of the ever-increasing complexity of these innovations. For example, the multiplication of the number of people and companies connected to a single mortgage, including mortgage brokers, specialised originators, the securitizers and their due diligence firms, managing agents and trading desks, and finally investors, insurers and providers of repo funding. With increasing distance from the underlying asset, these connected businesses started to begin relying more and more on indirect information, including FICO scores on creditworthiness, appraisals and due diligence checks by third-party organisations, and what they considered most importantly, the computer models of rating agencies and risk management desks. Instead of this spreading risk, it instead provided the fertile ground for fraudulent acts, mismanagement, and finally, market collapse. Regulatory overhaul. The severity of this financial crisis necessitated a massive public expenditure so that various international governments could bail out certain banks that were about to fail, provoking a populist chorus of "never again." Since the banking regulation, supervision and corporate governance had failed in numerous countries, it reinforced a commonly held view that banking crises are a recurring phenomenon. The 2007-2009 financial crisis, however, led to a substantial number of people requesting that a review be undertaken of banking regulation and supervision across the globe. The regulations, which were drafted in response to this public outcry, were primarily aimed to cover bank liquidity, capital, corporate structure and compensation. The hope for these policy initiatives is that they will contribute to a much more stable international financial system for many years to come. It has been considered that these wide-ranging regulatory reforms for the international banking sector constitute one of the most turbulent periods of regulatory transformation in contemporary history, which is exemplified by the enactment of more than 80 substantial pieces of legislation and rules after the crisis. These global banking reforms included a diverse array of policies plus specific measures, and select examples of some of the banking financial laws enacted in the United Kingdom after the crisis include the following. Banking Conduct of Business Sourcebook, or BCOBS. It insists that banks are fair, clear and not misleading in their communication with customers. The Financial Conduct Authority, the FCA, can now fine banks or even in some cases remove them from the register if they infringe on these rules. There was an extension of the FSA's approved person regime. It extends a regime ensuring bankers are fit and proper. Competency, honesty and integrity are all considered in their assessment. FSA Remuneration Code makes pay more transparent, discourages short-term risk-taking and allows for the return or repayment of bonuses. The Banking Act 2009 allows the Bank of England to close a bank before its balance sheet becomes insolvent to keep the financial system stable. EMIR introduces new requirements to improve transparency and reduce the risks associated with the derivatives market. CDR2 and CDR3 makes banks safer by making them hold more capital and improve their management of liquidity risk. CRD4 implements internationally agreed standards on more capital, more liquidity across the European Union, making it easier for banks to facilitate international trade and provide additional forbearance for customers in mortgage arrears, as well as introducing a cap on remuneration. The Banking Reform Act implements a framework for compartmentalising the largest banks to better protect customers' deposits, legislates for bail-in measures to ensure that taxpayers' money will not be used to save failed banks, introduces a senior persons regime to hold key decision makers accountable and make severe misconduct a criminal act. Bank Recovery and Resolution Directive. It requires banks to prepare recovery plans and authorities to be ready to resolve failed banks without recourse to the taxpayer, while requiring creditors to be bailed in. Single Resolution Mechanism complements the Single Supervisory Mechanism, the SSM, and provides a structure within which to coordinate the resolution of a failed bank, including the possibility of creating a single resolution fund. The Deposit Guarantee Schemes Directive enhances protection for bank account holders by increasing the coverage and transparency of the deposit guarantee. MER and CSMAD. These two pieces of legislation together extend the scope of the current market abuse regime to cover financial instruments traded on new categories of platforms and the OTC. This will more closely align the way in which market abuse rules apply to commodity derivative and underlying spot markets, which include improper activities relating to benchmarks within the scope of market manipulation, introducing offences of attempted insider dealing and market manipulation, ensuring national competent authorities have a minimum set of investigative and enforcement powers, and establishing a harmonised regime of minimum criminal and administrative sanctions across all of the EU member states. MiFID II and MiFIR improves investor protection, increases transparency, and continues the harmonisation of regulation across the EU. EC Bank Accounts Legislative Package increases access to basic banks' accounts, improves transparency and legislates to make account switching easier. Packaged Retail Investment Products, or PRIPS, increases the consistency and transparency of complex investment products for retail customers. Central Securities Depositories Regulation harmonises securities settlement in the European Union. Multilateral Interchange Fees Regulation reinforces the single market by promoting more secure, innovative, efficient and competitive card payments. Fair and Effective Markets Review raises standards, professionalism and accountability of individuals and strengthens regulation of fixed income, currency and commodities markets. A new potential role. Despite the reputational damage retail banks suffered from the financial crisis, they still hold a fundamentally trusted position in society as the stewards of assets and commerce. While the public still gives low ratings to the banking industry on matters of trust, their opinions about the banks they do business with are far more favourable. This is a critical advantage in the digital era, because when it comes to handling personal data, customers always trust their bank above any other provider. Obviously, those banks that can use client data to deliver value to them without sharing it with others are the most favoured of all. This now puts banks in a potentially advantageous position due to new analytic technologies, making it possible for banks to use transaction data to deliver savings to customers, as well as generate revenue for themselves. For those financial consumers that are satisfied about their trusted relationship, this now presents banks with a new frontier for loyalty and growth. However, banks must not lose focus on earning the right to a deeper commercial relationship by maintaining transparency and inviting their customers to opt in by their choosing for further benefits, rather than the banks deciding this for them.